U.S. trading platforms isn't the big problem. They are actually subject already to federal standards on that. The real issue here is that the basic investor protection standards we have in the securities market and the derivatives market aren't being observed by these trading platforms. And by that, I mean the rules we've developed over decades to protect customer assets, to prevent a trading venue from operating a conflicting business and having conflicts of interest, rules to prohibit fraud and manipulation. The trading platforms aren't observing those, in part because they say, well, we don't have to register with the Securities Exchange Commission. We're not selling securities, even though the chairman of the SEC believes that they should. The exchanges will say we're selling commodities, and there's no federal regulator in the U.S. of what we call the commodity spot market, meaning when you go and buy Bitcoin for cash. So that's the problem. These exchanges aren't following traditional standards. And that's why we have these risks. The risks of trading crypto aren't just the volatility of the assets, it's the trading venues themselves.
And that's a very good point, and you very well articulated, Timothy, given the fact that there seems to be an interpretation problem over here. And while that gap remains, how will we be able to address this issue? I mean, is there enforceability that the regulators can come heavy on these trading platforms and saying, no, you need to abide because, you know, in the broader context, you do fall under the securities law?
Yeah, possibly. It's possible that the SEC will bring an action against them, but that could get litigated. That could take a long time. What I've said, along with Jay Clayton, the former chairman of the SEC, is that the SEC and the CFTC should come up with common standards. The standards we want here don't really turn on whether you call a token a security or a commodity. They're pretty similar. So the SEC and the CFTC should get together.
I want to understand what the common standards are. Does that mean putting limits on upper circuits, lower circuits, putting limits to how much leverage can be taken, collaterals?
Limits on leverage, limits on conflicting businesses. You would say a trading platform can't be engaged in trading for its own account. It can't have, an affiliated market maker that's getting special deals, that's front-running customer trades, that's getting an advantage in the way that the matching engine works, which is what was going on with FTX. You'd have tougher standards to prevent fraud and manipulation. It's been estimated, for example, that wash trading, which is where someone trades with themselves or an affiliate, in order to make it look like the price is higher or boost the volume, it's been estimated that wash trading represents 50 to 80% of the volume on a lot of crypto exchanges. That's the kind of thing we have to stop. And we have to have much tougher standards on protecting customer assets. So that's what I mean by common standards. We want those whether a token is a security or a commodity.